this whole analytic thing, you know, checking out different states, and they kind of did a combination of potential appreciation and cash flow, and so, you know, anyway, they just had a whole analytic thing based on that. Anyway, Indiana as a state came out #1. Who came at the bottom of the list? California. And again, they're saying, look, we've had huge appreciation, and all the projections I'm seeing, and I don't know for sure, we'll see what happens, but all the projections I'm seeing is that California's capped out. Now, I'm sure there's, you know, exceptions to that, et cetera, but we've really gone on a big run up, and our cap rates are super low. So where's the room there?
Yeah. You feel that website's pretty right on as far as your information?
I mean, I read through some of it, and it makes sense, you know, from what I'm seeing. I can't say it's, I don't know if it's spot on or not, but, you know, they just had their own little method of saying, okay, if we took how much appreciation we should get, and how much cash flow you're going to get from the cap rate or whatever, you know, what states make more sense. And look, everything I'm seeing, the whole southeast here, massive migration down there from the rest of the country. You know, a lot of people, I mean, right now Texas is the #1 growth state in America, followed right behind by Florida. I mean, I was down in Florida beginning of this year, and we were looking at property, and I mean, I actually have a business in the Clearwater, Tampa Bay area, and it's doing really well, but we went down south of there, down to Fort Myers, and I couldn't believe it. It was like rush hour in LA for hours down the freeway there. I mean, there's so many people moving. We went to a subdivision down there, and they're telling me that it's almost a year waiting list to buy a property in that subdivision. There's so many people, but there's 10,000 people a year retiring, and I'm from Canada. I bet you 1/3 of Florida is owned by Canadians. Because everybody goes to Florida, and everybody in the Northeast has a, you know, a condo or something down there, and, you know, you're not familiar with it here because we already live in Wonderland, but anyone in the Northeast has property or goes down to Florida, you know, and the same thing's happening with North South Carolina. There's a ton of retirees and other kind of people moving down here, and it's making it very healthy. And then a great study. You guys ever heard of Bruce Norris?
Yes.
Okay, so he does really good stuff. You can Google him, and he's got really very, very good quality stuff. Bruce Norris?
Bruce North?
Norris. N-O-R-R-I-S. Anyway, I went to a thing he did beginning of this year, and it was very good. He's very keen on Florida. That's his kind of, and also Texas. He actually sold all his stuff in California and went to Texas and Florida. But he was pointing out in Florida, for example, okay, so you've got all these people retiring there, right? So obviously they're buying more homes to live there and move there. But an interesting thing, what happens as somebody gets older? Somebody's 65 years old, got a good pension, retires to Florida, gets a cheaper house, you know, having fun down there with his boat and fishing and stuff. And what happens as he gets older? Well, he hits 70, 75, he needs to start going to the doctor more. Eventually, you know, his wife can't do the housework, so they have to hire people to come in and do the housework. Eventually his wife dies, and then he has to, you know, have some part-time help come in and do things for him. And you know, as somebody gets older, they need more and more caregivers. And I just went through this with my folks. My dad's 90 now, actually. And, you know, we've had to keep increasing the services he gets, right? He has to go to the doctor now very consistently, almost weekly. You know, and so all these other services that are around somebody getting older is skyrocketing the employment in Florida. Because this is probably the it is the #1 state for people to retire. So that alone is a built-in generator of jobs, long term. Right? So you look at stuff like that. Yes?
So even when we look on Google Earth, it said, what disappears when the ice melts and the water rises in Florida is the first place that disappears in the map. You go, geez, how did they do that?
You know, yeah, the whole climate change thing, look, we could spend hours. I saw a great talk the other day on that specific point. And this guy, anyway, he's a really interesting guy. He goes, guys, think about this for a minute. How many people are moving to Florida right now? It's one of the #1 states in America. Are people getting bank loans? Is there developments? Is there all this stuff happening here? I mean, it's massive, the development happening in Florida. Can you get a bank loan? Is there any disclosures about you're going to lose your property to water levels rising and burying their, you know, property underwater? Nothing. The banks, look, the banks aren't stupid, okay? They got a lot on the line. They have no problem lending in Florida. None problem at all. Obama just bought a $12 million beachfront property in Martha's Vineyard. So, I don't know. The jury's out on what's happening with all this, but there's a lot of smart people that are really dialed into what's really happening out there, and they're buying property, beachfront property in Florida. And so, we'll see what happens, but it doesn't seem to be bothering anybody. There's a small segment that are worried about it, but the majority aren't. So we'll see what happens. Yeah. I mean, the only thing I would say about Florida, because like I said, I have stuff going on there, you don't want to be right on the waterfront, because that's where you get hit with the hurricanes. If you're like half a mile in or something, it gets windy, but it's not that, you know, you gotta, and they build for it like that. Look, you talk to people about Florida, and you mention California, they go, why would you live in California, right? You're either gonna get burnt up, or you're gonna have a hurricane, or have an earthquake. So why would anyone in the right mind live in California? But we know that it's only certain areas you have to worry about. Not all of California's burning up. I mean, every time there's a fire, my dad's calling, is your house okay? But I mean, you know, it's a big place. Yes.
And good luck getting fire insurance. We're up to $8,000 a year.
Yeah, but you're right on the forest or whatever. Yeah. Well, okay, I'm gonna make one other comment. I read a great article the other day. Shoot, I should have. Anyway, it was really, really interesting. So they were talking about all the, you know, hurricanes and fires and all these things that are happening, and about how claims are going up and the amount of losses, etc., right? So this guy took this area down here in the southeast and said, okay, what are the losses being incurred by hurricanes graphed as a ratio against the GDP, the gross domestic, you know, the amount of the economy going on here, and just see what it comes out to. Guess what? It's an absolute flat line. And what he says is, how many more people live in Florida today than lived there 50 years ago? Twice. How many more people live in this area compared to 50 years ago, right? So when a fire happens, there's way more people, and there's way more houses and homes and buildings out in the country, or in the, you know, these fire zones or whatever, than were ever there before. So when those fires happened 50 years ago, nothing really happened. You know, one house burned down. Now the fire happens and 20 houses burn down. So we've encroached in all these areas, and it made it far denser, so that when something happens in a hurricane, there's, you know, 10 times more buildings there to get hit and hurt, right? So, the study he did was, there's no increase on a percentage basis. When you take a population basis and the GDP, there's no increase. But we hear about these multi-billion-dollar losses when Hurricane Irma comes in or whatever else. But, and it does happen, but again, on a percentage basis, it actually has not increased for a long, long time. Yeah.
I was speaking with my accountant and talking about investing out of state, and he cautioned me about, and California is the only state that does this.
Oh,
when you do your taxes, you know, I think where I'm going.
Yeah, I do.
There's a form to fill out, and if you don't file and fill that out and file it correctly, if you moved money out of California for, let's say, rental units, whatever, investment properties, you would get hit with a capital gain tax from the state of California. What is the name of that form?
I'm not sure the name of the form, but I know what you're talking about. So this is what happens. You sell a building in California, right? And if you would have just sold it and paid the taxes, let's just say you had a $100,000 tax bill, you would have had to pay the franchise tax bill for it, right? Okay, but you do a 1031 exchange, and you buy a property in Florida or wherever else. Eventually, if you sell that building and you do pay capital gains, you still owe that original $100,000 back to the state of California. Even if you moved. You might have moved to Nevada where there's no tax, but if you sold the property that went out of California, and even if you're no longer in California, there's a, what's the term for it, clawback. They call it a clawback provision, where the state of Florida, state of California, and I think it's the only state that does that, they can claw back that tax. Now, if you die and there's a step up in basis, there is no tax.
Such as leaving it in a trust, a living trust.
Yeah. So, I mean, if you bought a property in Texas, you pass away, your kids inherit it, that property had a step up in basis, there's no capital gains. So, my understanding is in that scenario, you wouldn't have to pay the bill back to California. But I'm not an accountant, so check with accountant to make sure. But that's the way around it, that I understand. But you're right, unfortunately, you know, look, California Franchise Tax Board is way more onerous and way more hard to deal with than the IRS. I hear that all the time from people I deal with.
My accountant calls it communist, so.
Yeah, well, unfortunately, we're recording this, so we don't want to.
Go ahead.
They can see me, they can't see you. All right, let's keep going here. So we can talk a lot about Indianapolis. There's a bunch of reasons, but it's a state capital. It's a nice, stable market. And again, you're not going to buy something here and double your money, but you shouldn't buy something here and have it cut in half. You know what I'm saying? It's just a good cash flowing, stable market. What we're doing here are these small single-family homes, and we have a guy we work with, and he buys these homes out of foreclosure. He goes in, fixes them up, puts a tenant in there, and rents them out. And you can buy these homes for around $80,000 or $90,000, which I know is a big shock when you're here in California. And they're going to pay somewhere around a 9% cap rate after expenses, and that's after paying the management company and everything. Most of the properties, probably 80% of them, we've done in this area here, maybe the other 20% around here. And when you're in Indianapolis, it's literally 15-minute drive to downtown. Very accessible, very easy to get around there. And yeah, we had some investors out there, but these are just kind of normal, kind of low-end suburban homes. Now I know Dan is, saying we don't do any government program tenants. No Section 8, none of that. We want working people. These are primarily 3-bedroom, 1-bath, and over there, that's kind of the norm there, because these are old, they're built in the 50s and 60s. But they're all rehab. And if you look at the neighborhoods, we can give you addresses, and you go on Google, you probably see more on Google than if you went there yourself, but you can see the neighborhoods. They're all just nice, everybody's got their lawns cut, there's pickup trucks, but there's no bars in the windows, they're just plain Jane neighborhoods. This is not South Central LA or something like that. So even though the houses are $80,000 or $90,000, they're just simple neighborhoods, right? And again, they're a little on the lower end, but they're not really bad neighborhoods. Yep. Earl?
That's the stuff right there that you really should be promoting.
Mm-hmm.
People buying those, 1, 2, 5, 10, you get up to 10, you go there, you hire a young property manager, so your
Yep.
person is answering directly to you. That's the stuff. And mortality. Mortality is the hugest thing in this business.
When you say
Young
mortality,
people in their 20s, early 30s, buying that stuff.
Yeah.
5, 10, 20 of them, it's a no-brainer. You're 60, they're paid off. If they didn't go up a dime, you got a nice positive.
right? Yeah, and I didn't pay him to say that. But he's right, and we have people do that all the time. So these are great starters if you're, a newbie investing. If you were to buy one of these, you could probably put 30% down and get a loan. Truthfully, I encourage people to not have much debt, if any debt. I would say 3/4 of the properties we sell have no debt on whatsoever. People are paying all cash. Because when there's a recession, look, there's one thing I can absolutely guarantee everybody in this room. We are going to have a recession. I can't tell you when, I can't tell you how bad, but it's going to happen. I've been through 2 really bad recessions, and you don't want to hear the horror stories. But one of the biggest problems is debt. And if you have a lot of debt on your assets, and not a lot of wiggle room, 2 things happen. One, you lose a tenant, you now have horrible negative cash flow. And the other thing is you've lost all your equity, okay? So I encourage people to put as much down as you can, or at least buy all cash if you can. Because, if you have a property like this, and Dan talked about this earlier, you pay, say, $80,000 for it, and there's a recession, and you were getting, what's the rent of this one? It was $900 rent. What's the worst thing that can happen? You lower your rent, right? And if you have no debt or very low debt, and you have to lower your rent from 900 to say 600, which would be really dramatic, because you can always rent a property. You can always rent a property in a half-decent neighborhood at the right price. You're always going to find a tenant, right? So again, you just lower your rent, and you're still positively cash flowing, or at least breaking even. So if you have a lot of debt, and you're going negative, and you're paying out of your pocket, you know, it's painful, and that's where people really get hurt hard. Because if you have staying power through a recession, we always come out of them, and it always kind of boomerangs at the other end, but you got to have that staying power. So again, I always encourage people, very little debt, if any debt, if you can get away with it. Good question?
Yeah, if you buy into a neighborhood where most of the people own it, if you have to, you can sell it to an owner occupant, get maximize, you know, what you get back out of it. If it's, you know, Section 8, then you're gonna have to sell it to a investor at a discount and
Right, exactly.
anything else.
Yeah. But anyway, we do a ton of these. They work out really well. Here's a good, you know, so the guy we work with, he goes in, new flooring, well, depends if he puts a whole new kitchen, but depends on the kitchen. Always puts in a new bath. Doesn't use carpeting. He always puts tiles in. These are utilitarian. They're nothing fancy at all, right? But they're great rentals. And you're going to get a little family. They try to rent to families. Families tend to stay 3, 4, 5 years. You know, they don't turn around as much because the kids are going to school and all that stuff. The only problem we've had here, which is different than California, is that the rent is seasonal. So if you had a release come up in December, people don't like moving in the middle of the winter in Indiana. They just don't like doing it. And the winters actually aren't that bad. I'm from Canada. It's pretty mild there. That's me. But it's more, I think, the schools, you know, because we want to focus on family kind of stuff. And so the kids are in school, they don't want to move. So if you lost a tenant in December, you might have to wait 3 months or 4 months to get a new tenant. If you lose a tenant in May or June, boom, you get new tenants right away. Never had a problem getting a tenant in the summer.
Compensate in the summer.
That could be, yeah. Yeah. Anyway, so if you're interested, let us know. We also do other stuff in Indianapolis. This is Pizza Hut we did. When we do properties out of state, we want to do something with very little management problems. In Indianapolis, we have a great management company we work with, and you know, they handle all that. But on a commercial building like this or whatever, we like triple net lease. In this case, it was a brand new renovated Pizza Hut, 20-year lease. Again, you know, you're not going to get rich owning this property, but you're not going to lose money on it either. If we have a recession, what's going to happen with Pizza Hut? Nothing.
Pizza.
Nothing. Nothing's going to happen. People are still going to buy pizza. You know, it's not a problem. So, again, and then Pizza Huts are franchises. The franchisee that was in here was the largest franchisee for Pizza Hut. They had over 200 of them. So this is a real low risk. You know, when you're comparing, you know, types of real estate, this is super low risk. Okay? You're not going to, you know, this is going to pay around I think it was just over a 6% cap rate. And nothing exciting, but it's just going to be a nice, stable deal. You don't have to worry about it. This was an interesting one we did earlier this year. This was a industrial building, 4.6 million. We got it at an 8.8% cap rate with a 12-year lease. Now, see all these trucks here? That was the second largest manufacturer of ambulances in America. Okay, so I flew out there and had lunch with the owner of the company. I said, look, when we had the recession, what happened? He said, nothing. They had no change in sales whatsoever. They sold just as many ambulances in the recession as they did before and after. Because it's a necessity item, right? It's not people buying it. In fact, they sell a lot of theirs to Israel, for whatever reason. And, but they're selling to municipalities and, you know, fire stations and all kind of stuff. So it's a stable market that, you know, they had a good quality product and they had, you know, their sales probably are not going to go down in the next recession. So that's the kind of tenant you want to be in, you know, for a long-term help to life. Okay, so let's talk about Texas. We like Texas a lot. Dallas is just booming like crazy. Again, now they actually are having pretty good appreciation right now in Dallas because it's just exploding there. We can thank California. A lot of the people moving there from here, you all probably know about Toyota. They moved into Plano. In fact, let me show you. I'm going to skip down here a bit. Yeah, I took these pictures probably 2 years ago. I was out there in Dallas. This was a brand new complex that FedEx had built for their global shipping headquarters. There was like 1,200 people moved in there to work. Right across the road from it, literally, like right up the driveway, you see, whoops, oh, I'll get it right here. There we go. Liberty Mutual had just moved their headquarters from Boston, and 6,000 people are going to be working in this. This is finished now, but 6,000 people moved into this complex. All those cranes there is one complex, massive. And then right next door to it, literally sharing the property line, was Toyota. And again, that's finished now, but 4,000 people are now working in that complex. So that's a lot of people for one intersection. And you hear all kinds of stories of companies moving there. It's just crazy booming. Frisco, which is kind of a town in the north part of Dallas, I was talking to a developer there at the beginning of the year, and he said, he was boasting, he said, the only city in the world that's got more development happening than Frisco was Dubai. I mean, it's just, there's so much stuff going on there, it's amazing. One thing that we've been doing for clients, and right now it's actually getting harder and harder to find good deals in Dallas, because it's a lot of people buying. But one thing we've been doing that's been working good are these townhomes. So there's a developer we work with, and he builds stuff north of Dallas, which is where all the growth is. And you can buy a townhome for around $260,000, $280,000 for about 1,800 square foot, brand spanking new. You've got a great property management. They agreed to not close escrow until you have a tenant, and it's going to be about a 6% cap rate on those deals. And you should see appreciation in that market. In the last 2 years, ones we did with other clients, we've actually seen, half decent appreciation. So we have some of that available. Another one. Yeah, and these are real nice. I mean, one reason why people are moving there, I mean, you can go there. I don't know if I can just slide here. Sorry, I didn't have this one. Anyway, I mean, think of what you're getting there. This is, somewhere around 2,000 square foot property, brand spanking new, state of the art, and you're going to get it for under $300,000. For $500,000, you can get a 3,500 square foot brand new home in Plano, which is a very nice area. Yeah, it's crazy. In fact, they're saying that someone, like, for example, someone from Toyota moving to Dallas, if they have the same salary when they move, when you factor in the fact that Texas is a tax-free state and all the cost of living, factors, because it's so much cheaper there, it's like getting a 50% raise for a person moving there.
Is that office building or manufacturing?
This one here?
Toyota.
Oh, Toyota? That was their office. I mean, I'm sure they have some manufacturing too, but the office is what we showed you.
I see we have a triple net lease there, but then you have absolute triple net.
Yes.
Does that mean have a different meaning there? Or?
Well, yeah, I'll explain that. Well, first of all, this was, we had a client who sold an apartment building in Glendale, and he wanted something, no risk or whatever. So this property came out. We actually knew the developer who built it, so this was never on the market. 15-year, brand new building, brand new lease, everything. And it's right in Plano, which is where all that stuff's happening. This is, Dekra is actually a $1 billion plus company out of Germany, and they signed in the lease. It's not a franchise or anything. So that was a really good deal. What this is in Texas, you have to get your car checked every year, safety checked for the DMV.
Yeah.
So it's sort of like a Jiffy Lube. You drive in, they raise your car up, they check your oil and your brakes and all that kind of stuff. So, first of all, it's a 15-year lease with a huge corporation. Second of all, even if something happened, they didn't renew that lease 15 years from now, someone's going to go in there, there's going to be some kind of Jiffy Lube or somebody's going to want that, because it's right in the middle of a residential area, and there's just nothing else around. There's a few other buildings around it, but it was perfect. Anyway, you asked about a triple net lease. What that means is, sometimes you see triple net leases where the tenant is responsible for everything except for the structure and the roof. Okay? A lot of them exclude the roof. That's not uncommon. This one did not exclude the roof. So anything, if there's a roof leak and they have to redo that roof 10 years from now because there's a hailstorm or whatever, the tenant has to pay for it. So that's what we mean by absolute triple net lease. Literally, anything that goes wrong in that property, the tenant has to pay for it.
Gotcha.
Yeah. And that was done at a 6.2% cap rate. Yeah. So, this was a little more high risk, but this was a industrial building we did just north of Dallas, 8.4% cap rate. Actually, when this one, the lease was coming up, and we knew it when they bought it, so a little bit of a gamble, but they bought it at such a good price, they weren't worried about it. So they've already had an offer for more than what they paid for it, empty, because the tenant didn't renew the lease. So that's, you know, you have to be careful to see what you're buying that property for. But the market's so good there that you wouldn't worry about it. Okay, so let's talk about Houston. We do a lot in Houston as well. Again, similar graph here. When LA went down, they had a little softening. Houston is just booming as well. We were just out there actually a week ago, and there we're doing something a little different. We've been doing these manufactured homes, and so let me explain how this works. So we have a group we work with. They're one of the largest owners of manufactured home parks around Houston. They have like 35 of them, and they go in, they build, you know, they buy the land, they put in all the streets, and they put in all these units. And this was a park that we sold all the units in already, but once it's all rented up, then they sell off the individual units. So as an investor, you can buy one of those manufactured homes, okay? Now you're not buying the land. The land, you're gonna have a 30-year ground lease on that lot, but you're gonna own the building, okay? This one was only about 2 or 3 years old. You can see it's gated, they got security. You know, there's a bit of a stigma on these kind of properties in California, but that's because the land here is so expensive. You're gonna build a, you know, you're gonna put in multi-family apartment complex or something there if it's California. But in there, it's very common to do this, but they're nice. In fact, we went with a group of investors last week that wanted to see them. And normally when we go out there, there's always, you know, some empty units we can go in and show people. We went to 3 parks and they didn't have any empty units. I mean, it's really strong rental market there right now, very strong. Anyway, so we do a lot of these. These average about $50,000 a unit, depending on how old it is or whatever. And we have them all around the market, and they're nice. I mean, you'd be surprised when you go in them, but they're really well built. A lot of questions come up about how strong they are for a hurricane, all that kind of stuff. Well, what they've done in actually all across America now is there's zones, depending on how windy and how much storm stuff there is. So the government has blocked out the whole country that way. And so on these kind of things, there's specific requirements depending on what zone you're in. This was in zone 2, and let's see, I'm sorry. I need to get a picture in here. Well, anyway, you see that there's a skirt here, and I mean, if you lift that up, and I should get a picture and put it in there to show you. They have these blocks, you know, like, and pylons that go into the ground, and they're all along the length of the building, and that's the foundation. And then they have a metal strap that goes over the building, and it's, you know, underneath the roof inside in the framework. And so they're bolted down. And in this zone, there's 12 of these metal straps strapping this thing down into these pylons that go 6 feet in the ground. So if there's a hurricane, these are really strong. And also they're precision built in the factory, so again, the frame is really strong. I mean, they're built to withstand high winds and stuff. And so in fact, they're telling me that they had one park, a place called Rockport, which was right down in the waterfront down in the Gulf. And when they had the major storms 2 years ago, they had a few broken windows, and that was it. These are as strong, if not stronger, than a regular house now. But again, the government really upped the ante in all the requirements. All right, so as far as an investor, this was that park I just showed you. It's all sold now, but it's a good example. So they're around $50,000 a unit, and after all the expenses, and they manage everything for you, and you're getting it with a tenant in it, it nets out to around 11.5% cap rate. Now, you're not going to get appreciation on these, okay? This is 100% cash flow play. So it depends on what your strategy is, but we have guys buy them. We have a lot of guys right now that are saying, look, I'm going to sell my property in LA, I'm going to go out of state, and someday the market will soften back in LA, and then I'll come back here, right? So this is a great way to park money. And there's 2 things here that we negotiated with them that's really good. There's a maintenance program, so part of your cash flow, $38 a month goes to the maintenance, and so anything that goes wrong in that property,
you're not gonna have to pay extra money. Because a big complaint everybody has is you get nickel and dime to death by your management company that manages your property. So we kinda handled that by saying, you're gonna pay $38 a month